hear me? Here we have the VIX, VIX. What is it? 3/21, 2012, $25 call. What is it? The volume is important. Look at that. 70,889 VIX calls, $25 calls. That's a VIX. It's a fear indicator. What people are betting on or using for insurance is that if the VIX goes higher in value, so if the market sell off and the VIX go higher, they're betting that the VIX goes higher back above the $25 call strike price. Now, when you look at what the VIX closed at, it's invert, it's a fear indicator, but nonetheless, you need to understand the mechanics that people believe that there's a correction coming. Otherwise, you wouldn't see that kind of volume, period. And that you see increased volume where a lot of the people that are involved believe that there's a directional change, that the bull would be overbought right now in 2012 as of 2/22 of 2012. And, you know, if the VIX was to go higher in value and the market sold off, these would definitely go up in value. And as a matter of fact, you can see here recently where the highs and the lows were. The last high the other day was $3.40. Okay, and the lows were 238. So basically, the last time that the low was at $1.60, which is today, you had lows up here at $1.25, $1.20, $1.19, $1.45 between 2.6, 2.7, 2.8, and 2.9. And you can see what the open interest was at the time, 151,000 contracts. At that time at those price levels. Today's volume is the most heavy transacted volume within this bull run in February. Right now, 70,000 intraday contracts. You don't see that being bought. Those are people's beliefs. We're going to take a look at the purchasing these at a wholesale price. People believe that the complacency factor in the S&P 500 would have to reverse. That's the S&P 500 index. And then that it would have to cave in, and that the VIX, which is a fear indicator, would go higher in value, and people are betting that that's going to happen in the short term in the marketplace. And this is your S&P 500 that got top in heavy. Here we have the S&P 500 index, but once again, the fear indicator. Here's a chart of the VIX Market Volatility Index, CBOE. We're at very low levels in complacency. What people believe when they're buying those 70,000 contracts, the calls on the VIX, is they believe that the VIX is going to rise above $25. There's the 200-day daily simple moving average is at 26. So it makes sense. They believe that the bull would have to have a good pullback in order for that to happen. Well, let me tell you something. The bull side is very strong at the moment. Yes, the bull side is due for a pullback. Yes, people are very complacent. Yes, people have less fear than at any other time. Otherwise, you couldn't be this low. But last week, there was a little bit, and we came up to the 22 level. And we've got major resistance levels. So 200-day simple moving average on the VIX is at $26. You have a top that you got to get through. It's going to be the $24 handle. It's going to go right over here. So there are big bets being made that the market, once again, will have higher volatility and a sell-off would be around the corner.